Down fractionally across the board for the U.S. major averages as stocks are falling to end a volatile week after weaker than expected consumer sentiment data. Joining me now, we've got Keith Gangle, who is the Gradient Investments portfolio manager. Keith, you say that investors should, quote, bring an umbrella for 2025. Explain what you mean by that.
Yeah, we think the last 2 years have been fantastic in the overall market. They're up, 2 years ago, it was up 25%. Last year, again, another 25%. So in aggregate, the markets have been up 60%. So while we're still favorable for the markets, we think it will get more of that normalized return of that 8 to 12%. We think you need to bring an umbrella. I think we're going to have some kind of corrections as we go throughout the year, a 5 to 10% pullback. Shouldn't be a surprise. So we're warning investors that they need to bring an umbrella, prepare for a little bit of rain. How do you do that? I mean, if you were a 60-40 client, a couple of years ago with the big run up in the stock market, now you're more like a 70-30 client. So what we want them to do is rebalance, get back to that 60-40 where your original plan was. Another way of doing it is we have some structured buffered portfolios that provide some downside protection, but also allow you to participate in the market on the upside. So that's what we mean by bringing an umbrella.
With that in mind, this has been an interesting week because, of course, we have more news coming out of DC and policy decisions that are rolling out. You also have more earnings reports. And then amidst all of this, you still have the NASDAQ and the S&P 500 still notching some new record highs. Of course, we're moving off of those levels today. But what does that tell you more broadly about how this market is weathering some of the larger kind of events that could prove volatile?
Yeah, it's pretty impressive with all the negative news that you just talked about that the markets haven't been selling off, especially, again, after we had these nice big run. The S&P, year to date, it's almost up 4%, even with all this news. But I think the market investors are looking through it. If you look at the earnings forecast for this year, expectations are for 14 to 15% EPS growth this year, followed by another 14 to 15% next year. We think that's a little bit too optimistic. We think it's more maybe like that 8 to 10%. But again, even with an 8 to 10%, that's a good backdrop for the stock market. I think that's what investors are looking at. They're looking at that earnings growth potential and unemployment rate's at 4%. So if consumers are working, they have money in their pockets, they're spending, I think that's going to continue driving the markets forward.
All right, what's driven the market so far and over the past 2 years has really been this Mag 7 trade. However, you're looking at 6 names specifically and taking one out of that basket, and that's Tesla. Why is that?
Yeah, Tesla, I think, is pure on valuation. It's a name we like. They're very innovative. Musk's got a lot going on right now, but it's a name we don't want to own here. We think valuation's too expensive. The EV market's coming under some competition. We haven't seen where batteries are going. Robo-taxis is still on the come, and I think that's what everybody's betting on. But that could end up getting pushed out to the right, so we want to wait for the stock to come in a little bit more before we get interested in it.
And so with that in mind, how are you kind of positioning for yourself right now, looking out into the back half of this year where we're going to be waiting for some of the interest rate decisions as well from the Fed?
Yeah, so we think the market can start broadening out the last 2 years. Almost been driven, solely by the Magnificent 7 names just, running high. So we think, obviously, you still want to be involved with those names, but we don't own Tesla. We own the other 6. You want to still own them. Just probably maybe own a little less than your benchmark. And I think the market's going to continue to broaden out. You want to look at names like healthcare, some industrials, things like that.
You're also looking at Netflix, Dexcom, Palo Alto Networks, and a company that also just reported this week, Walmart. Just walk us through your kind of top pick thesis on these names.
Sure. We like leaders in the space. And the first one you mentioned, Netflix, they had a phenomenal quarter, big beat, had, big numbers on their sub ads. So that's a name we continue to like. They're the leader in the streaming space. Everybody's chasing them. We think they can hold that premium multiple. And again, as ad revenue kind of builds on their new model, we think that's a good thing for them. You mentioned Palo Alto. They had a really good quarter. Again, they're a leader in the space. Everybody's looking for security. With all this new AI play, they're going to be the beneficiary there. Walmart's the one that disappointed, those names that we just talked about. Again, they had a good quarter. Guidance was subpar. They took EPS down by about 8%. That's why the stock went down. Stock is not cheap. Now, we have to keep an eye and see if the consumer's actually getting a little bit pinched with some of the stuff like high interest rates. Are the consumers starting to put more on their credit card? That's something we have to continue to watch. But I think Walmart's taking share, so we still want to be involved with the name as well.
Keith, thanks so much for taking the time here.
Thank you.